Hey, welcome to Windcore Real Estate, and today we're going to talk about how to run the numbers. And we're going to talk about two key rules that you hear investors talk about all the time. The first one is the 1% rule. The second one we're going to talk about is the 50% rule. And let me reiterate, these are rules of thumb. These are not the end-all be-all numbers that you're going to do to ultimately decide if you're going to purchase a property or not. This is just kind of your filtering mechanism to see if you're in the right ballpark, to see if you go the next step. So let's cover the 1% rule first. The 1% rule is that your monthly income should be 1% of the value or the investment in the property. So run an example. Say you have a property that is worth $100,000. And this is after you purchase it and put your money into it. This is your entire investment. If you get a $1,000 a month rent from that property, then this property meets the 1% rule. And what you typically don't want to do is go below the 1% rule. The higher you go up, the better the numbers. So for example, if you have a property that is, say, $50,000 and you're into it and you rent it for $750 a month, that turns out to be 1.5% of the property. So this is a property that is cash flowing significantly more than the previous example we gave that was just the 1% rule. Now typically these are lower end properties and the maintenance of them is higher. You have a lot more turnover. So there's no magic number that says this is necessarily more profitable than this one. But typically the higher the number is, the more cash flow you have. And if your only intent is for cash flow, then you wanted that number to be higher. But let's go into the other direction. The 1% rule, say a property is worth $200,000 and it only rents for, say, $1,500. Not a bad deal. It's a lot of rent, but that doesn't meet the 2% rule. It'd have to be $2,000 to be the 2% rule. So this one is lower than the 1% rule, and so you won't get as much return. And many investors look at this number. If you go any lower than the 1% rule, you're down to the 0.75, 0.8, 0.9. Maybe not worth putting that much money into a property to just get a 5 or 6% return. Okay, here's an interesting rule of thumb about the 1% rule. It basically assumes that if you assume a 40% expense ratio, meaning that 40% of all rent goes to operating expenses, insurance, capital reserves, or maintenance reserves, then you will get a 7% return. 7% cap rate or return on your investment. So that's just a quick and dirty example of how you can look at numbers real quickly and say it's $1,000, like we said before, rent, and say it's worth about $100,000 or $100,000, that you're getting about a 7% return on that $100,000 invested. And this is completely not counting in if you're borrowing on the property. We're keeping it simple. That's how you look at the 1% rule to see if you're even in the neighborhood of if it's a property you're interested in. So now we'll go on to the 50% rule. The 50% rule is basically a simplification of what I was talking about, the expense ratio. The 50% rule basically states that you assume that the operating expenses of the property is 50%. So take an example of $1,000 in rent times 12 months is $12,000 of income. Multiply that times 0.5. Quick and easy math, $6,000 is how much you actually earn from the income or the net operating income. This is referred to as the NOI, net operating income. And that's the number that you use to determine your cap rate. So if you invested $100,000 in this property, then you would be getting, let's see, if you put $100,000 into that property and you're only getting $6,000 back out, then you're getting a 6% return on your investment. So the cap rate on that property would be 6%. And that's the 50% rule, is that you take 50% of the annual income for the year to determine if it's kind of worthwhile. If you then, again, this is ignoring the amount of debt that you have on property. This is assuming an all cash investment. So what I do is I took a look at the rent for a property. Say it's a random example of $800, and very quickly I understand that $400 a month is going to go to my operating expenses, just like that. I only have left $400 left of potential income, so my debt payment cannot be any more than $400. In fact, it needs to be lower. So if it were a $250 debt payment, I'd only be making $150 net after all of my expenses. That's kind of how I look at each property. Very quickly you can see, that property is going to only rent for $600 or $650, say, and the person that I'm working with on a owner financing deal, they want a $500 payment. That's just not going to work because I'm already too far into the expenses, so that there's no room for me to make money in any cash flow. That's the whole point of income investing properties, is to find cash flow. So that's the 1% rule and the 50% rule, and how you can very quickly filter through all of the deals that you look through and see if you're even in the same ballpark.